Hey folks, welcome to another episode of Business Redefined. As always, your weekly, most comprehensive look at the world of business, finance, and economics. 2025 is off to a dazzling start. We want to talk about matters banking, and we are pleased to have Director Consumer Banking at Absa Bank, that is M, Moses Musyoka Mudui. Karibu sana.
Thank you, Julius. Thanks for having us.
How is the new year?
Oh, very good. I think it's off the blocks.
All right.
Early days, but a year full of dynamics. Ready for it.
Karibu sana, Moses.
Thank you.
2024 closed, and the general sentiment from the Kenyans I spoke to was that that is the year in which the banking sector, by and large, flouted what we like to call the social contract of banking. We saw yields tumbling down like bowling pins, but Kenyans who are borrowing from banks felt as though the interest rates remained too sticky where they were. Was this the case? And if that was the case, what reasons would you have?
Yeah, look, I think that's a great question. One of the things I really enjoyed last year in my job is traveling around the country, seeing our customers, visiting our branches, opening some branches in far-flanked locations around the country. And really, when you see how banks still continue to interact with the society and that relationship, it gives me every reason to say the social contract of banking is intact. However, 2024 was also a year of significant reflection points because, with these types of unwritten contracts on how various aspects interplay, there's need for continuous reflections through up and down cycles. And one of those points was, as the interest rates were going up, we actually got to a point where our models told us continuous increases in interest rates would take tens of thousands of customers into default. Okay. So we actually halted further increases in lending rates, despite macros and all our models and other factors we look at are telling us that we should increase interest rates. And no one wins in that scenario. You tip over customers into default. The shareholders do not benefit because you carry credit losses. Yeah. The economy weakens. But we took the hit and said we'll plateau any further increases just given that reality. So that's just one example of how I think you arrive at a point where you pause and reflect on the right thing to do, despite what data is telling you. And then on the volume side, in terms of money flowing into the economy, there was a real big opportunity last year for banks to continue extending short-term bridge financing credit. Where, as you know, risk premiums do not determine the price. Yeah. It's whether you can access finance. And I'm sure you'll see as, we go into published financials and so on and so forth, just the amount and quantum of lending and money that actually just happened through short-term borrowing, digital channels, bridge financing, because we realized we have to keep the lights on. We have to keep the oxygen to commerce flowing. And that volume side also came at play. So I'd say, one unique year to just continuously reflect about the right thing to do within the circumstances.
Okay. And looking at where the yields are now trending because of the sort of correction we have seen, and it looks like from the first two auctions in the T-bill market for this year, 2025, it looks like yields are now plateauing off. How do you see that evolving? How does it shape your decision-making from a lending standpoint?
But the general sentiment is that we've hit the very highs in terms of lending rates, and those are coming down. And the KBA issued a statement in this regard, and we are very much aligned towards that direction, yeah.
Okay. Yeah. Now that you have touched pretty much on the macro space, the latest update we got from the International Monetary Fund is a bit cautious, telling us we have enjoyed some very steady disinflation, where inflation is falling,
yep.
But that will not be as accelerated as we initially thought. So here we have seen 2 point something. It looks like we'd be going further up now. And many viewers would be curious around how do you see inflation playing out and how does that influence, again, your lending?
So look, I think, first of all, the first thing to recognize is the fact that those very muted increases of 2%, 2.4% are off a very high base. So, actual price levels elevated quite significantly about 12, 18 months ago. So on a year-on-year basis, one could say inflation is quite low. Yes, it is, way below the upper end of the range.
But the base effects are significant.
Precisely, yeah. The base effect is quite different. Yeah. I think there are a lot of dynamics in here in terms of what happens in the global space, imported inflation. The good thing is we've seen oil prices have come down, corrected quite a while. But locally, I think, we are not sensing any high single digits to a point where, monetary policy will start to go the other way. I think it's well to say inflation is anchored. Once we look at the core data, that will tell us any signals we have to look at in that space. So I think, by and large, the inflation problem it looks like it's been settled. It's been anchored. And so we have to just watch on how it plays out the coming few weeks. Yeah.
And when Moses talks about the core data in inflation, remember we have the headline inflation, which you normally get from the National Bureau of Statistics, and we have core inflation, which now removes the noise from food items because they tend to be very volatile. Moses, it's mass media. And now that you have touched on that, Moses, you mentioned the issue of bridge financing. Yeah. From a distributional standpoint, what should we expect to see from ABSA and any other player, considering the sort of volumes we saw coming through digital lending in 2024 because of the environment we were playing?
Yeah. So we have a fairly well-diversified business. We serve consumers, small businesses, large businesses, and corporates. Fair to say, the upper end of our business continue to still see a lot of significant credit expansion, and that continues. Just given the economics there in terms of, large corporates and big businesses. Consumers is where we really saw the squeeze. And at some point, it wasn't about whether, people are credit worth to get loans or lending from banks. It was just affordability. Take your mortgage at 8% and recalculate what you have to pay at 16%. It's gigantic. And of course, income levels have not corrected over the period. The good thing about this is that we think monetary policy is now anchored. We think that's at optimal levels. Obviously, we count our blessings in terms of where interest rates are, where inflation is, currency is stable. And that gives us a lot of signals to continue, to expand lending. But I think the physical side, which is the other part of the conversation, I think on the very short term, clearly we have challenges to deal with. I think, the fiscal rectitude needed, fiscal consolidation, living within your means, and the dynamics that come at play to drive fiscal consolidation, Just try and attempt to live within your means within your own household, and you see the dynamics that
constraints
that come at play. Social superiority, and those are tough goals, and they're not immediate benefits. To what we have to look at on the fiscal side. Over the long term, obviously very optimistic. I'm a patriot. I wish my country does well. We are doing all our best to make sure it does. But until and unless we begin to see incomes, especially for the low-income earners, expanding, and that comes with a whole host of benefits: dignity, social formations, less crime, ability for people to put food on the table, let alone to begin to have capacity to borrow. So I think, for me, while we can tick the box on monetary policy and say everything looks great, on the physical side, continues to be a lot of work to do. So I think it's going to be a fair balance on any infused economic growth from banks participating in lending in the economy, purely because the fiscal side it takes long to get right. But I think we're doing all the right things.
Okay. You mentioned that the consumer side experienced a bit of squeeze, and this is a docket which now sits right under your purview. And I'm curious because everyone in the banking in the retail side I've spoken to told me 2024 was a slippery hold. You barely can hold it on the retail side. Yeah. Was it a baptism of fire when you look back?
This is how I'd put it. We almost dealt with everything, that one could deal with in a medium-term environment. And the reason I say that is we came into the year with rapid rally in interest rates. Defaults started to follow, went into a period of uncertainty, political unrest, social unrests. And obviously, I think you feel it in the consumer business day one when you can't open a branch or you're not able to host customers to transact from the branch environment. And then obviously, I think we saw defaults ticking up. When you look at our Q3 financials, which is the last public data we have, we're still sub 10% in terms of our NPL. So we had a very good quality book and with the defense position. I think in terms of the appeal of our brand, taking that out to the market, making it mean something to people, drove significant customers or customer acquisition in the bank, which again, it's one of those things when you look at the underlying customer franchise, Are we doing the right thing in the brand? Are we rolling out the right products to the consumers? Are we staying very close to our customers? And the importance of staying close to customers elevates itself during periods of uncertainty. So when you look at those measures, it tells us that the underlying customer franchise is strong and solid, and we are proud about that. But a lot to deal with. There was something new every day, and glad we're here now in 2025 and looking forward.
Now, Moses, you mentioned Q3 numbers, and I'm tempted to go into earnings, but we shall reserve that for March, I guess. 2025 is the first year under which the core capital requirements are revised in line with the amendments which we saw in the Business Laws Amendment Act of 2024. Currently, initially at 1 billion, progressively being bumped up to 10 billion over a 5-year horizon. This year is being knocked up to 3 billion shillings. One, what do you expect in terms of the shape and form the banking sector takes in light of this, and how are you positioning yourself as ABSA?
I think when you look at historical precedents, when you study any global financial market or any economy, you realize that strong economies need strong banks.
Yeah.
And that does not mean fewer banks. It just needs stronger banks. And so the Act is very progressive in that nature. And financial markets and the financial sector is as resilient as the ability of banks to deal with the challenges with internal capital positions, as opposed to reaching out for regulatory support and so on and so forth. So to the extent that this Act allows banks to build their capital basis, just means that we're looking forward to a more resilient economy and a more resilient financial services sector, given how those two are connected. Obviously, this throws out a number of options for players. Very likely, banks that need to raise additional capital may look for equities from existing shareholders. Think about how they manage their retained earnings or profits, how much you pay for dividends, vis-a-vis, how you manage retained earnings holdings. Hopefully think about the asset base and any need to change business model in terms of their balance sheets to make sure just that organic part of the business generates capital. But also inorganics, consolidations where those happen. And I think, Julian, when people think about consolidation, it very quickly becomes, is it a Game of Thrones? You set a number of rules and then see who survives. I think there are win-win strategic alliances that the industry can motivate as we go through this. But I think it boils down to 2025 being a very dynamic year, especially given that one act, which is very progressive. Yeah. And I think the opportunities here for players with the strategic currency, the ability to drive some of those options. And at the end of the day, back to the first question you asked, the social contract of banking, the ability for banks to stay solid and strong is very much linked to economic fortunes and the ability to build economies. And I think this act and this law is squarely progressive in that nature.
More directly, Moses, is this the beginning of a season where scale gains an unprecedented currency in the banking sector?
I hold a personal view that the industry, especially the banking sector, as a space for scale players and niche players. And the both business model are valid business models. When you look at what we call Main Street banks, which is consumers and SME banks, those have got some advantages when they're scale businesses. When you look at Wall Street banks, investment banks, they can thrive significantly when they're monoline and niche players. And the real importance of a scalable consumer and SME bank or a Main Street bank is one, this market is very big on relevance is equated to presence. People need to see you to start to feel something about you. The more people you touch, the more people you reach, the easier is it for you to mobilize deposits and on-lend those deposits where they're needed in the same economy. The ability to drive costs to serve, per unit cost reduces as you serve more people, and those benefits are passed into lending rates and banking fees. That efficiency is passed there. The greater good, whether it's financial inclusion or financial access, you only tick those boxes based on the coverage you have and the meaning you have in that coverage. Yeah. And so I'm a big proponent for scalable consumer and SME banks. It doesn't mean the other models are not successful, when you think about economies of scale and economies of scope, what can you actually do with the diverse set of consumers or SMEs that you have? This ability to, collect deposits or capital and deploy those financial resources to help the very same economy. For me, I think that business model will continue to stand in good state, meeting very many stakeholder needs and expectations here.
Also, you have touched quite extensively on the subject of deposits. And when we had our conversations last year, including with yourself, I think, one of the headaches that bankers were grappling with were expensive deposits. Just how much of a challenge, let me not say a problem, a challenge was it in 2024? How do you see it shaping up in 25?
The way we like to think about this is deposits are only as expensive as where you can deploy them. Because truly speaking, everyone there who's got deposits is looking for a return on those deposits. It's only fair because on the other side, we lend at a price. So yes, the price of deposits tends to get informed by the overall interest rates.
Yeah.
And obviously we saw what happened, in quarter one, quarter two, and quarter three. Public data is out there for quarter three. You saw what happened to our cost of funds. But we did not per se turn away any deposits because, as I said, the rotation opportunities to use those deposits to lend through short-term lending, digital lending, where margins are quite high. So on a net margin basis, you can still, as a bank, from a shareholder return point of view, manage your economics there. But this notion that, we stay open for business in good and not so good times.
Yeah.
Banks must therefore accommodate both the environment, their consumers, and the term deposit for us is quite relative. It's just, one, is there a need to keep the deposits? Is there a liquidity challenge to manage or opportunity there? Do you have opportunities to lend? And more fundamentally, when you think about the customer and the client franchise, it's not the product. When you think about the customer franchise and the customers within the conversation, people deserve to hand on their deposits based on where interest rates are. And okay. I think we were very much aligned with that view.
Wonderful. FX. About 18 or so months ago, when in an environment where no one could even claim to know where FX is going, we seem to have found a resistance level at the 129 units to the USD. What's your outlook on FX, Moses? And do you see the level being retained? Do you see pressure emerging, especially given the global macros?
Look, I think the largest driver in the FX conversation is really what happens in the global scale. There's a new administration in the US, Trump season 2 or 2.0. Once you isolate the politics and the policy, there are mega trends in the policy that begin to determine where the currency may go from a US dollar point of view. It does prefer a weaker dollar to help US exports. That has a direct correlation to the Kenya shilling to the dollar. Just because of the policy stance and some of the actions that we are seeing on that part of the world. You've seen his appointments in the Treasury Secretary, Scott Bessent, a former hedge fund manager.
Yes.
So he's thinking about the US as a corporate or an enterprise. And that will mean that sentiment and the policies behind that sentiment will impact what happens to Kenya shillings and any other currency in the frontier markets relative to the US dollar. Having said that, I don't have any strong focus or strong view. I think we must give it to the authorities for really managing down and anchoring the currency where it is. We've barely moved 128, 129.50. That's for a period of time. And that stability is needed. That stability of currency helps people in business. We hope that some of those global dynamics do not come, against the local shilling. Clearly, we'll see where the interest rate outlook goes, because those go together. Your view, which is shared with mine, we seem to have plateaued on the trough of interest rates, so which means there's likely to be more stability on the currency. But it's a wait and see. But no news at this point to think otherwise than a stable currency, just given the actions and some of the things I've touched on. Yeah.
So Moses, to infer from what you've said is that your foreign currency book is not giving you any sleepless nights.
Yeah, look, I think that's an inference. I think it's fair to say, but I think we see stability across the balance sheet. Um, in fact, we see opportunities to build the balance sheet than to cut any positions further.
You began by mentioning, or rather touching in passing, the discussion around the fiscal environment.
Yeah.
And as you'd imagine, where Kenya is right now, that's a huge conversation happening. And we keep on asking this question as to whether fiscal consolidation remains the elusive path that Kenya is chasing. And when you look at where we are, right now we are in anticipation of supplementary budget 2, 24-25,
Yep.
and we are wondering whether we can really retain interest rates where they are, or whether the plateauing off we have seen in the recent auction just tells us the sharks have seen some blood in the water and they're just waiting.
Look, I think every country, name any, Japan, the US, countries in Europe, have struggled to really get it right in terms of fiscal consolidation. First, given the political economy side of it. And then on the other side, you're actually thinking about people's incomes. Taxes equals to from an income.
Yeah.
Or how that income is spent. So people's disposable incomes. So it's a very delicate endeavor to nail fiscal consolidation over the long period of time. I think there are countries that get it right. And then we have the unique expectations in our end, with our debt profile and what's happening in 27, what's happening in 32, and so on and so forth. So it must be the case that people are burning the midnight oil to just see all these moving parts around with the upcoming finance bill. Are there tax breaks for the low-income earners to increase disposable incomes? What happens on the expenditure side? How do we prioritize expenditure? The IMF program comes up end of April. That's in the mix in terms of those decisions. But I think macro stability, monetary stability, as I said, is a blessing we can say
We have,
right? And it's a good foundation to think about macro stability. But macro stability will take time, and it takes time. I think what we need to continue seeing is those examples of what happens to income levels, what happens to expenditure, and whether the deficit is expanding, contracting, or staying static. The outlook on rates, yes, will be informed by deficit positions, but also maturities of debt that are ahead of us. But it will take time, in my view, for macro stability from a fiscal point of view, despite all the right things that are being put together now. Some people would argue short-term cautiously pessimistic, but long-term very optimistic.
That would be a good blend. For the better part of 2024, Moses, one of the conversations which dominated our discussions in banking was the subject of bad debt.
Right.
And as you did mention, because of where interest rates were trending, you were worried about tipping your consumers off into default. As we look into 25, how do you see this playing out? And more granular faced is the flow problem that we have from stage 2 going to stage 3. Seems to be an amplified problem at the end of last year.
Yeah.
Do you see that prevailing?
Yeah, I think if you look at our quarter 3 numbers, you saw, the flow to default levels had gone up.
Yeah.
I think that was same across the industry. Suffice to say, most of that pain washed out last year. And it's a function of, defaults are a function of people being able to pay or not, which is a function of can you afford, which is a function of where are interest rates at. So as banks reprice their portfolios, you'd expect interest rates coming down 600 basis points from where they were.
It's quite significant.
Q3 to where we are today. Of course, you'd expect that to give some form of relief as banks begin to reprice their portfolios, reprice their customers in terms of the flows to default that we saw in the Q3 year to date, or last year until September. So I think it's getting better. I think the question though is there pent-up demand? In other words, people waiting to borrow because prices have reduced. I think that's a problem statement. During COVID, there was a lot of demand for credit, but there wasn't a business environment to apply that borrowing and that credit. Yeah. So much so that when we started going out of lockdowns, lending lifted, and people could borrow because interest rates were low. There were tax breaks. Incomes were not damaged. We didn't see layoffs and so on and so forth. And so there was this demand that was waiting to be fulfilled. And we saw people really borrowing as we came out of lockdowns and business environment opened and so on and so forth. Now it's a little bit different.
Yeah.
There's barely any pent-up demand because, to your point, interest rates are coming down, borrowing rates will be low. But on the other side, ability to have sustained credit worthiness over a period of high interest rates and high defaults just leaves a very small window for any demand that is waiting today. So yes, we might see some growth in private sector credit growth, but not as we saw it post-COVID, given there's no demand that is waiting to be fulfilled.
And now on that point, Moses, because if you look at the latest CBK data, credit growth to the private sector is really muted. I mean, when talking about the low single digits, does this concern you, Moses? When you look at it, how do you, because we view it as borrowers, but as a banker, what comes to mind?
I think the obligation for banks to continue driving private sector growth is so crucial. We might want to look at the formal long-term or structured, whether it's a 1-year loan, 3-year loan, 5-year loan, 10-year mortgage, that is accounted for in private sector credit growth. And the informal private sector credit, that is through digital platforms, mobile money, and we have those short-term credit, overdrafts. And when you look at these two, the flow of money in the economy is quite there. It's quite significant,
Okay.
right? So when you study the numbers that way, but I hear you, the headline 1.1% private sector credit growth is a point of reflection and concern. But whether there's money flowing in the economy through other channels, of course, we've seen people who would come to borrow a 3-year, 5-year loan, pivoting back to borrow on their mobile 30 days, 60 days, 90 days, and still keeping up with their credit payments, but still meeting the need for credit without necessarily writing a long-term loan or a long-term mortgage and so on and so forth. So I think we need to look at it holistically and ask ourselves, as an industry, how much money have we put in the economy? Because, as you know, from a financial point of view, short-term borrowing does not end up as an asset in the balance sheet. You don't wait for the end of the year and say there was 20 billion.
Yes.
But it's dispersed every month, every week, repaid, dispersed again. So the volume and the supply of money in the economy from a banking industry point of view has been quite sustained, just that it's balanced much more towards short-term lending. Yeah.
Okay, let's talk a little bit about strategy here. So a few months ago, you and I sat down, you were just taking up the new portfolio, and we're discussing your strategy for consumer banking.
Yep.
About, I would say, 11 or so months down the line, do you feel you're on course? And as you look into 2025, what's your strategic play?
Look, I think ABSA must become a leader in understanding customers and meeting customers' needs. The big shift we did in the strategy for consumer banking, which we talked about, was to shift from a product-led business to a customer segment-led business. And the distinction is crucial because, Julian's, products approach has its own benefit from a financial and commercial point of view. You adjust parameters, you work on pricing, you sell more. Okay, you sell more, you earn an income, and so on and so forth. A customer segment-led approach allows you or requires of you to think slightly differently because people are not products. Yeah. People matter. People's stories matter. Your story matters, as we like to say at ABSA. And so think about a customer segment business approach allows you to build a consumer bank. And so the transformation we are on is transformed from a retail bank to a consumer bank, but make sure we understand consumers so well. We have data. Data tells us something about these consumers, so we can get insights from that data. With insights, we can create demand, the sentiment. How do you want people to feel about you? Only then do you say, what is the proposition, not the product, that you offer these consumers who you understand so well and with whom you've created a sentiment. And then once you have a proposition, how do you fulfill it? And once you fulfill it, it only starts day one after you fulfill a proposition because you do customer value management. What is the value for this customer over their lifetime? Now, that takes time, but it's absolutely the right thing to do. That shift takes time, but it differentiates between retail and consumer. And ABSA must become a consumer bank that truly understands people. And based on that, then builds its own business.
Moses, I've mentioned this to you before as you speak about a consumer-centric approach to your strategy. Speaking about the industry by and large, there is a view, and I get this from emails, from inboxes on X, from Kenyans, that our banking sector isn't really driven by that consumer-centric approach to the needs that we have. Fine, you can talk about we are proliferating products in the market, but they don't speak to the nuances, especially around the mid and bottom tier of the market.
Yeah.
Is that a fair assessment?
Look, I think everyone out there, based on data, conviction, choice, has made certain decisions around this topic. My own view, which is a shared view within the company, is we've got to get segmentation right and then serve very specific segments based on the needs in those segments. The affluent segment, you've got people who are thinking about crafting a legacy, and they want their story to be continued. They think about intergenerational successes. The thinking of that consumer is quite different than another consumer in the same affluent segment who is living their best life. The nuances are quite clear. So the approach, therefore, on that affluent segment has to be equally nuanced. When you think about personal banking, which is what you call mass, the mass segment, these are people who are trying to balance so many priorities every day in the same shilling. So the thinking there is also very different. Is how do you offer value? How do you allow them to stretch their shilling by understanding that their realities are very different than your affluent consumer?
Correct.
Then you've got the next generation consumer. People want to experience banking differently. They think branches are Stone Age, but they still want to go and talk to a human being and interact.
Yeah.
So you can offer, branches, but also digital. And the nuances there are also very, very different. So my strong view is that, those buckets, I've just given you an example of 3 segments. Those buckets require nuanced approaches if you have to truly get back to the point that, people are not products, people are people. And banks have to get to a point where, of course, we monetize products. We're in business. We have commercial fortunes to make. We have shareholders' returns and obligations. But a long-term sustainable business is one that's built by understanding consumers much more deeply than offering products into the market. Yeah.
Moses, as you talk about the new generation banking, the last conversation we had, I remember posing the question to you that it looks like ABSA, which we have traditionally known as a niche playing bank, wants to scale play. And I was asking you whether there was a plan around revamping your branch network, because remember when you rebranded, you had a consolidation or rationalization, if I could call it. Now that you're talking about the new generation banking and how they want to experience banking differently, how do you straddle both worlds?
We have seen case studies where, you go to Europe, you go to the US, you come to the continent, where the arrival of digital finance was misunderstood as a replacement for branch-based finance. And different players took different decisions.
Yeah.
There are those who went big time in closing branches and investing in digital. There are those who waited to invest in digital and kept branch sizes, numbers, coverage as they are. And there are those who drove the road in the middle. Suffice to say, after, probably 15, 17 years, the jury is still out there. But I believe that, digital will never replace physical, and that the two will complement each other. That people want to access finance with ease and efficiency on their mobile phone, but they want to go to a place to have a conversation around their financial needs, a place they call ABSA. That human interactions will never be replaced by technology, even in the age of intelligence, even with AI. And so understanding that these two are there to complement each other is right at the center of the strategy we talked about last year. So much so that our branch network is expanding. Now the shape, the format, the uses of those branches might change over time. We opened about 5 branches last year. We have plans to open more this year. So that number is going up close to 100 branches by 2027. Yet we're investing significantly on digital for ease and efficiency, for what you'd call mundane transactions to be very easily transacted through digital. So I think these two things, bricks and clicks, will complement each other, but clicks will not replace bricks over time as we build out the strategy. I could be wrong, but I think as we speak, I think we see we see the need to drive our strategy that way.
Well, I'm being flattered that our time is fast spent. And when you and I sit down, we can talk until the cows come home to roost. But let's wind up here. Depending on who you talk to, there are various views as to what will be the overarching trend shaping banking in 2025. Some say it's AI. Some say it's geopolitical shifts like what we've seen in the United States with the change in administration. When you look at the banking sector, especially from an African perspective,
it's fair to say geopolitics will come into play. Trump administration should not be underrated in terms of how that influences geopolitics and how that influences the mega trend on trade between the U.S. developing world and developed world. I think that's a big trend we should watch out for. Technology has been here, will be here, will continue to be here to transform banking. And technology is just not technology, it cuts across industries. So that trend continues. There are obviously, I think, emerging fears on the continent around sovereign stability. So what happened in Ghana is a sovereign, what has happened in Southern Africa, and so on and so forth. So that will determine the ability for global players, banks on the continent, and big African-based banks on how they deploy capital, especially on the public sector side. That's a trend we should look out for. I think we should continue to see regulation continue to play their role to drive, fairness and across industries. Pricing is a big component. Back to the question mark that remains. Are banks here for the good times, or are banks here for all the times? And through those down cycles, we've talked about the importance of the banking sector will continue to be elevated. But I think the biggest news is, of course, short-term Trump volatility, but next 100 days will tell us a lot more around the geopolitics and the mega trend on trade, rather, and what that does to the continent. But at the end of the day, Julian's, we've always learned that the world is not binary. There are a lot of good things out there and a lot of opportunities out there, but also equally difficult things out there and risks out there. I think at the end of the day, all things balance out. So the conviction to make the choice for banks to stay present and committed in economies and stay open for business is one expectation you can have on us, especially ABSA.
All right. We have been having a conversation with the Director, Consumer Banking at ABSA Bank, that's Triple M, Musyoka Moses Bodui, largely on the moonshots around banking in 2025, speaking about strategy, the global macros coming into Kenya, interest rate environment, FX expectations. Keep it Business Redefined for any breakdown, especially when the earnings start rolling out in March this year. Stay tuned.